Hi there, folks. Charlie Gipple, the owner of CG Financial Group. Want to talk real briefly about a pretty serious topic, which is private credit, private equity in the insurance space. You know, if you were in 100 different boardrooms of insurance companies over the last month, probably in 80% plus of those boardrooms, you would have heard a conversation around private equity in the insurance business, especially the annuity business. What does that mean? What are some risks? What are maybe some positives to that? Let's talk about that. But first, let's step back and talk about private equity, which, by the way, article in the Wall Street Journal earlier in April of 2026, that is, for those of you that are watching this in the year like 2050, because this video is going to be so darn timeless, right? Earlier in April 2026, Wall Street Journal article said that private credit is now like 25% of the general account portfolios nationwide. 25% of the general account portfolios, at least when it comes to the fixed allocations or something like that. $1 trillion is what the number was that was in the Wall Street Journal. $1 trillion. It's gotten so big and so fast that the article said that it's basically outpaced regulations, state insurance departments regulations, NAIC rules, which is a little bit concerning, right? Okay, so it's very prominent in especially the annuity space. What does all this mean? Well, let's talk about private equity. I have a lot of friends across Iowa, across the Midwest, that both they invest in private equity as well as they're the recipient of private equity investments. I have friends in Southwest Iowa that own companies that actually get investments, get cash infusion, so to speak, from private equity so they can grow their company big. So what does all this mean? So first of all, you have a private equity company. And at these companies are generally some very smart people, right? And they may specialize in certain industries. Let's say that, using my Southwest Iowa example, you have a private equity company that specializes in agriculture. This company, they know how to build agricultural companies. They know of great investments out there. Maybe a mom and pop shop out of Minnesota or whatever, to where if they had some sort of a cash infusion, it's almost a given that this company is going to be freaking big and would be a great investment for somebody, the private equity company, to give it a cash infusion, right? So that's what the private equity company does. It finds good, creative, and sophisticated opportunities for investing money. But do the owners of the company generally reach into their pocket and use that? Well, they might, but that's not where most of the money comes from. The money comes from investors. So we talked about the outflow of private equity, right? Where they invest and where do they get their money from? Well, the SEC and FINRA says it has to be accredited investors, right? What the numbers are doesn't really matter, but you have to be fairly wealthy, right? Like more than $1 million in net worth, have to make a couple $100,000 a year, or an institutional investor. And there are various levels of whatever you call it, accredited investors or qualified investors. But in short, you have to be a sophisticated investor to give your money to a private equity company. So those private equity companies, when they come and solicit me, for instance, I have to be an accredited investor for them to do that, because I have to be sophisticated. Well, why are there rules where you have to be sophisticated? That's different than just buying a Walmart bond, for instance. Well, that's a public thing. That's a publicly traded company that has a bunch of disclosures, a bunch of transparency around it, right? AM Best put their stamp of approval on it. Standard & Poor's put their stamp of approval on it. That's a Walmart bond, buying a Walmart bond or a Treasury bond or whatever. That's public stuff, in contrast to private stuff that I'm talking about here. There's very little transparency, right? That private equity company, what they invest in, I mean, you know, it's not the same as public companies out there. Very little transparency when I invest my money with that private equity company. Maybe oftentimes there is leverage involved. You know, if I give a company a couple $1,000,000, they may leverage that up X times. And we know that, yes, leverage can enhance a return in good times, but it can also enhance the losses in bad times there. And also maybe illiquidity. What if I want my money back? Well, mom and pop up in Minneapolis, for instance, maybe they want that investment for a 20-year period of time, or a 10-year period of time, or a 15-year period of time. I can't ask for my money back next year, right? So there are risks with private equity, but the upside is generally the more risk that you take, the more potential upside in returns that I, the private equity investor, get back. I know a lot of people that have made a ton of money investing in private equity, right? But those were the good times. And how does that private equity company make their money? Well, based off of the assets that they're managing. So they may charge me to manage my couple $1,000,000 or $20 million, whatever, say a 2% fee, plus maybe 20% of whatever the growth is. What do they call that? Carried interest or whatever. So 2 and 20, right? 2%, 20. That private equity company, if they do a good job, they're going to make a ton of money. But long story short, there is a good amount of lack of transparency there. So how does all this apply to the insurance industry today? So imagine if you're a private equity company and you say, I have so many great ideas, so much sophistication, how I can invest money. I just don't have enough money. I have a couple bucks in my pocket to invest, right? Who do we go to get more money? Imagine if you're a giant private equity company and you have an investor that is XYZ Insurance Company with, say, a $100 billion portfolio, for instance. That portfolio is actually going to invest in your private equity company. Dude, that's beautiful. So you have these insurance companies out there, and the money that's coming into insurance companies from folks that are buying annuities, that's billions of dollars a year in many cases. I mean, that's the dream of a private equity company, right? Hey, let us invest your money, XYZ Insurance Company. So much that a lot of private equity companies have actually purchased insurance companies. So now check that out. The insurance company is going to get the inflows into the annuities. The insurance company is going to make their money how insurance companies do, based off of a spread, right? But not just that, but the owner of the company, which is a private equity company, is going to get a good chunk of those assets, of the general account assets, and invest that with how private equity invests. And hopefully the goal is that private equity company actually enhances the yield that the insurance company is getting on their general portfolio. By the way, here's a positive so far to private equity is, I think it was a Milliman study that I read a few years back. Milliman had said, we estimate that, first of all, private equity has kind of done its job in enhancing the returns of insurance carriers' general accounts. And second of all, they quantified it. I don't remember if it was like an additional 50 basis points or whatever. But a general account yield to say 6.5 versus 6, that means better products as well, right? So that's what's going on in the insurance business, to the tune of, like I said, like $1 trillion, is not so much, hey, we're going to invest in Walmart AAA rated bonds that's 100% public. Imagine the stacks of information that's on Walmart, the company. Walmart is going to be able to pay that debt. They're going to be able to pay it back, right? We all know that because of the huge amount of information that's out there. With private equity, you don't have that type of transparency. Although there are some financial ratings that private equity companies or issuers of the debt can get, this article that I'm talking about went on to say that only like 50% of them have these private credit ratings or whatever. And as a matter of fact, those private credit ratings that were given on a lot of this debt, much of that was highly, highly criticized. I think it was by insurance departments on, whoa, that debt, you're saying it's an A-rated piece of paper? No, that's like, it should be 3 notches lower than that. So there's a good amount of criticism on how safe these investments, the customer's premium, is invested in when it comes to private equity. There's a good debate on that. But that's what's going on in the industry, and only time will tell how this is going to pan out when things get bad. All I can say is a couple things. Number one, know what your insurance company invests in. Number two, just because there is a good amount of private credit doesn't mean it's a bad thing. Just beware of it and ask the right questions if you're sitting down with the executives, like I tend to do at least a couple times a month. And you can bet I ask these questions. Remember to give me a thumbs up and subscribe if you like this.